Good morning, this is Goldie. It's Sunday, December 5th, 2010 at 11:11 a.m. Central. We have a very special guest, the Delicate Genius. We're doing a special rant today. Last night, the Eric Telford Collective played down here in Houston. And we're going to go over some Fed stuff so we have a little bit more of an understanding. There will not be a transcript for this show, so sorry about that. First of all, a buddy of mine whose brother is in the banking industry had sent a couple of questions to him, which I'm going to go over real quick, about the Federal Reserve. We're hearing a lot of disinformation about the Federal Reserve and very bad information, and so I wanted to try and clear up some things, and so that we could actually make decisions on what we like or don't like, or what they're doing, or who the heck they are, because I've never pretended to know. So in any event, I'm just going to go through a couple of statements, and the delegate will yay or nay me on this kind of stuff. So the first one is, the Fed is independent of the government, but is also banker to the government. All Fed profits are paid to the Treasury, and she's nodding at that. The Fed is responsible for and manages the payment system, FedWire, CHIPS settlement for interbank payments, and so forth. So they're actually the big banker. All right, well, Outlook decided to stop, so.
Their independence is, do you want me to try and get you on our network?
Nope.
Okay. Their independence is questionable.
Okay.
Oh, so because you asked 3 questions in the first question. I just opened that, hon. Please leave that open a little. I just opened it.
Kids, we're on the air. The Fed is responsible for supervision of the bank holding companies, was in charge of some of the consumer protection legislation, but failed to effectively manage this risk. I didn't know what that meant. We'll come back to that. Fed is the lender of last resort to the financial industry, domestic and foreign banks, for dollars, the international trading and settlement currency. Fed can create money and uses liquidity and reserve requirements on banks to manage the money supply. Fed works with other central banks, the IMF, BIS, to manage currency and interest rate volatility in global markets. Central banks have arrangements to borrow currencies from each other to manage volatile markets. Fed provided large dollar loans to other central banks during the crisis in late 2008 and 2009. Bernie Sanders and other critics of the Fed are outraged about this. Most of the world's physical gold supply is stored in the New York Fed vaults in the basement of the building on Liberty Street across from the Chase HQ. I know you said you didn't know. Okay, so that is some of what he had said. Now tell me, what is the Fed? When was the Fed started?
Fed was started in the 30s. I think it was 1934, and the Fed was started to ensure the global money supply, the transport and trade of goods and services required that there be a monetary base, and the Fed provided that in the form of currencies that were the dollar that was actually measured against the gold. So that's when the Fed got started, and the Fed's a very different institution now, although its primary responsibilities are the same, and that is to ensure stability in pretty much the global financial system, and to provide domestic price stability.
Okay, so it was originally started because of the run and the closure of hundreds of banks, the runs.
The runs on the banks and the currency stability that was required after the run on the banks.
Okay, so the currencies after the runs, because there were worldwide runs, right? Everybody.
Everybody.
Okay, and so who started the Fed? Was it the U.S. government?
It was an international organization. I mean, it was the United States that started the Fed.
Mm-hmm.
But the Bretton Woods system was an organization that was global in nature, included European central banks as well, and that organization and the Fed cooperated to peg the dollar to gold. and that
Okay.
was the gold standard.
We went on the gold standard.
We went on the gold standard.
Okay, okay. And so then, so a bunch of rich guys, for my Tea Party friends, because that's who owns these banks in 1934, very, very wealthy people, correct? Wealthy governments and wealthy people,
Sure,
correct?
sure.
Got together and said, this world will not survive unless we do this.
Fine.
Is that correct? I mean, I'm just trying to get some basics.
I don't know that this world will not survive, but it
That's
was,
what they felt. That's what they felt, that there was no way we could come out of this without this particular.
they thought it was a solution to the problem.
Okay, okay, got you. And then, so then they put together this thing, they put the dollar on the gold standard, which meant that you had to have the amount of gold was the same, I guess the value, they set a value for gold at that time,
They
or
set a
gold was
value
not
for
on a
gold.
free market?
They set a value for
Set a
gold.
value for gold, and that was the amount of cash in the system?
That was the amount of cash. in the
Dollars,
system.
dollars,
Right.
dollars. Or was it something beyond dollars?
It was dollars.
Dollars. Okay. All right, so that was in 34, and that didn't really help,
Yeah.
okay? And we kept going, and then now how has the Fed evolved? What have been the major changes that characterize what the Fed is today?
Well, I think the globalization of financial markets is having the greatest impact on who the Fed is today. And today we're using policy tools that we have never used before. It used to be that we would just print more money and change the relative value of our currency compared to others. Now we're using policy tools because the ones that we've used historically don't work anymore. And that is because we've been in what's called a liquidity trap. We can't lower, we have negative real interest rates, and we've had negative real interest rates for some time now, which means that traditional monetary policy doesn't work.
They changed the job of the Fed.
And so then we, the other tools that we're using, and we don't talk about too much, are the fiscal tools. And fiscal tools generally take 2 years to have an impact on the economy.
So like a stimulus program?
So the stimulus program
Would
isn't
take 2
supposed
years.
to have an impact right away.
Immediately
Something
could.
people are
it's
just
pure
not paying
political.
attention to
Gotcha.
at all.
But it's all political, what you
It's
hear
all
on it.
political,
Okay.
right.
So what did the Fed, what was their relationship to the, and I'm just, because I'm going to steer in a direction to get us to September 13th of '08. What was their relationship to the ability of these exotic instruments to be created? So what was their role in helping create and really exacerbate the subprime market?
Well, that's a really great question. I think that the Fed didn't understand the impact that 7 times leverage would have in the financial markets.
So they allowed greater leverage? Is that what happened?
Well, it's not the Fed. It was never the Fed's job to regulate hedge funds. It was
Okay.
never the Fed's job to regulate AIG. It was the Fed's job to regulate depository institutions.
So
It was
Citibank or Chase or whoever?
Right.
Okay.
And so there was a real there was a lack of oversight to these other conglomerate financial institutions that enabled them to be so incredibly leveraged. And it was basically the SEC's responsibility, although they didn't really have authority to do much about it, but it was their responsibility to oversee these institutions. And so I think the Fed was asleep at the wheel there in a way. It wasn't their
Like they
job.
weren't putting out
looking at it.
warning, but they should have known. They go, wait a minute, we're only 1/5 of the entire market. Us regulating these banks on how many subprime mortgages they can buy or write insurance policies on. They didn't say, hey, by the way, the other 4/5, whatever, I'm making up a number,
Right.
is controlled by the SEC, and the SEC needs to look at these other giant conglomerates that are not regulated by the Fed. Is that correct?
Yes, but it's also the case that some of the best Fed-like minds and models were incapable of modeling the impact that 7 times leverage would have on the system.
Okay, when you say 7 times leverage,
Well,
was that a
that's-
change in some policy?
No, what I mean by that is a lot of, institutional money was investing in strategies that were 7 times leveraged.
Okay.
And so a lot of pension funds and institutional money, including AIG and others, were buying financial constructs that were based upon borrowed money.
Okay.
Okay, that's all gone now. Nobody buys 7 times leverage anymore.
Okay, so what happened was the Fed was asleep at the wheel, asleep at the switch.
They should have known that the amount of money they were pumping in the system during Greenspan's era should have had a greater impact on inflation. They should have had some kind of...
And it didn't.
And it didn't.
And they didn't ask why.
They didn't ask why.
They didn't ask why. Okay. And that's their job to ask why.
It's their job to understand it, but again, it wasn't their sector...
If they don't understand it, then they should ask why. That's my point. Right?
Right.
They're supposed to understand our financial system and what's going on.
That's correct.
So when they pump a bunch of money in there, and we had all talked about that, where's the inflation, where's the inflation? The only inflation that was occurring was in property asset prices.
Right. And the bubble occurred.
Right, okay. So, simply speaking, we run up to 2007 or so. What started happening, really, at the end of 2007? Again, with relationship to the Fed.
Well, the Fed became a lot less independent at the end of 2007.
Okay, so what do you mean? The Congress started yelling at them, Republicans started yelling at them? Who started yelling at them?
At the end of 2007, we were in a world of hurt. And it was the government, I mean, it was a dire circumstance. Letting Lehman fail, for example, and having that impact AIG and Chinese banks, by the way, at the same time in a very big way. It was really important that somebody looked like they were keeping the free fall from occurring, and that was Paulson coming in and saving financial institutions in the way that he did. Granted, it probably should have been done in another way, but at that point, the Fed was acting like just a political organism, not an independent one. And so it was dispiriting to see that, but at the same time, it was such a critical time that I don't think, in hindsight, we could have done it any other way.
Okay, so really, what happened to Lehman? What exactly happened to Lehman? Just in 1 minute, basically.
You're out of money.
They ran out of money, and their counterparty risk wasn't quite understood. They had...
When you say counterparty risk, that means the people on the opposite side of these insurance policies. I just like to call it like a really simple phrase.
Yeah.
They sold insurance policies that were now being collected on.
That's correct.
Okay, because most of those, again, I'll call them policies, we can call them swaps.
Right.
Were insuring people against losses in mortgage portfolios.
Right.
Okay.
And then no one would trade with Lehman. Their credit lines went to zero.
Okay, so what happened was there was a whole bunch of investors that held all these mortgages, and then the foreclosures started happening because they couldn't find the next idiot to buy the house for $350,000 that they had bought for $300,000 that had been $250,000 the month before. And so then we started getting some mortgage defaults, and people were calling in or were making claims on the swaps, on the insurance policies.
That's right.
On Lehman. And Lehman just happened to be earliest, biggest exposed, just the earliest one. They happened to have ones that were called on. Who else?
Well, it may have also been the case, and this is where the politics come in, that maybe there wasn't a special good buddy deal available to Lehman that was available to some of the other financial institutions because of who was running the show.
Okay, when you say good buddy, to the Fed or to the Treasury?
To the Treasury.
To the Treasury.
Right, but in 2007, it's my opinion that the Fed and Treasury were total bed together. Right? They were operating as one.
Okay. And was that because of politics?
It was in part because of politics, but like I said, the situation was dire. We needed everyone to work together.
Okay, in 2007.
At the end of 2007.
Okay, so.
Hands on deck.
Okay,
Right.
so 2008. I'm just going to turn this to get your microphone a little clearer. Okay, so in 2008, in September, and a buddy of mine closed the deal on September 10th, by the way, because I always tell people in real estate, always treat it like it's September 10th. And so what exactly happened that weekend?
In 2008?
Yep, that was the Lehman failure. It was on the 13th. It was over that weekend.
Oh.
What exactly happened?
I've been referring to that almost
Oh,
this
okay,
entire
okay, okay,
time.
gotcha,
That
gotcha.
is, that was, Hurricane Ike hit Houston, Lehman failed, Bear Stearns was getting bailed out, yeah, I've been referring to that most of today. So that was the crisis that I was referring to. That, we had a financial, basically a run on all lines of credit. A run on all lines of credit.
Starting with Lehman.
Starting with Lehman.
So people panicked.
People panicked. The Fed panicked.
At the point
George
of Lehman.
Bush panicked.
But at the point of Lehman, there was an actual panic.
Absolutely.
Because then somebody said, these may not be the only, because that was the first public, I mean, there was Bear Stearns earlier, right? And then there's Lehman, and everybody starts looking at everything, going, well, what the heck does everybody hold in their portfolios?
What's behind this credit? What's
Okay.
behind this line of credit?
Okay, so there was a run on everybody.
On everybody, and anyone who was leveraged was running, anyone who was leveraged wasn't getting any more credit.
And since everything was running on credit at that time, and everybody was assuming they could renew all their loans at all times.
Right.
And
Because it
this
was
is in
so
real estate
easy
too.
to do.
And this was in real estate too. You could just call up your banker and go, you know what, we need another year, send me a $400 extension. Literally.
Right.
My clients wouldn't even use me at that time. They just,
And another thing to point out that occurred then is the banks, that now we're at QE1, right? Because the banks.
okay, so QE1 is called the bailout time that followed the panic
Right.
of Lehman.
Right.
Okay.
Okay, so what happened was, the Fed made available, like its primary responsibility, made available the credit that banks needed, and basically bailed out banks. Now remember, not only did, all the things we're talking about occur in 2008, but we also had the stock market completely crater. And
But
so
that was really after that, wasn't it?
it was still in the, it was, well, at the begin, no, it was
The
still.
real cratering, I'm talking the average Joe Q
It's
public,
October
Joe
of
Q.
2008.
Right.
October of 2008.
Because they did, I mean, believe me, I'm just talking average Joes.
Okay.
My listeners are average Joes, and nobody really knew this was going on. Everybody knew people were making money on house flips.
Right.
Everybody was like, real estate, I've made so much money on my real estate. And actually the stocks were doing well up until 2007, I guess.
That's
when
correct.
like the Dow hit 14,000.
August of 2007, we saw real estate stocks feel pressure.
Okay.
Real estate became weak, and real estate equity became weak in about August and September of 2007, but never really cratered.
Okay.
So now we're in 2008, October 2008. October 31st, 2008 was one of the worst days in the stock market. So now we're
Was
back
that the
to-
700-point drop?
Yeah.
It was like a Friday or something.
It was a Friday.
It was a Friday because I
It was
remember
awful.
people, and that was when I think Warren Buffett said he was going to put $5 billion in and buy.
Okay, right.
It's just, I remember that whole time because there were some people, some neighbors, and their friends were like, I'm going to buy $5,000 worth of stock, and I'm
Right.
just going to go do
It was
that.
still early.
Okay.
But
So that's what's going on in October.
But
that
remember
was-
what's happening in the bank's balance sheets at this point.
Right, this- I'm
because
gonna get to
their
that.
equity is falling.
Okay.
And their assets have fallen.
Right?
Then
Because their assets are these mortgage portfolios, which it turned out every single bank, I mean, effectively, every single bank
Oh.
and every single investment company held gigantic portfolios of mortgages.
Right.
Because it was a good deal. They thought they were smart. They were making money on these
well, and the
things.
small
They
community
could keep
banks, that's what
trading.
they do, right? And the what really changed, maybe 20 years ago was these small community banks got on that they'd sell their book of mortgage loans and buy the exact same security because they thought that was a risk-less trade
Well, because they had the insurance policy
behind it.
from whoever.
And they also-
It might have been from the same company that they were buying the asset from, the portfolio.
No, totally.
Yeah.
They sold the 30 loans. They got it. They got it securitized. They put it back on their bank books. And importantly, they did not have to hold as much credit behind that security because it was
Insured.
by the full faith and credit or quasi faith and credit or some private insurance company.
Okay, well,
So the leverage of the bank then occurs,
Right.
right? Because I don't have to own that much or hold that much capital, but yet the risk on the balance sheet isn't really any less.
right. Okay, so QE1 is the time when Bear Stearns gets tossed, Lehman fails, And then there's a run on credit, and everybody loses their credit lines.
All small businesses lose their credit lines because the banks that took money from the government could no longer have their small business lines of credit open. That was part of QE1.
But they didn't know, did they know the net effect was going to be that?
It happened like this.
Because that was the one pager? Was that the one pager that he had?
I don't know about the one pager.
Okay, the first TARP.
The first, that's
It was
exactly
a
right.
one-page document.
I didn't know that.
Yeah, it was,
Okay.
he came to Congress with a one-page
Okay.
document. We need this much money,
Right.
and we're going to fix it.
And every small business line of credit was cut in
Okay.
a day.
Okay?
A real major impact.
But that was the market really doing that, or that was the
That was the
QE1
banks.
rules?
That was QE1 rules.
So Federal
In
Reserve
fact,
rules?
No, Treasury rules. No, it was TARP rules.
Okay.
That's Treasury. That's
Okay.
not Fed.
Okay.
And TARP rules. Actually, it was also the case that people like American Express and Citigroup had, in order to take the money, had to get rid of these small business lines of credits and actually become some kind of form of depository institution so that they could take the money.
Okay, as well as every individual credit lines went away.
Every.
I mean, they took away my credit lines that I had a bunch of credit lines and not using them, and they're like,
Right.
because they were required to post capital,
That's right.
which they hadn't been required to do before that.
That's right.
There was some greater capital for the amount of credit that was out there.
That's right.
Okay, QE1.
QE1.
QE1, okay. So we're in October of 2008.
Okay.
We've done TARP. The Treasury has allocated $700 billion to be used for something, for QE1. Bail out who you can, who you want, who you think we should bail out, Federal Reserve. Is that correct? The Treasury tells the Fed that? Or does the Treasury tell the banks that?
Treasury tells the banks.
And the Fed's just sitting there?
And, well,
Twiddling their thumbs?
The Fed's working with Treasury.
Okay, so we're just looking for reality here,
Yeah.
just the way it did work.
Right.
So the Treasury recognized, somebody convinced the Treasury that this is the abyss. We are staring at the abyss and there's nothing staring back at us.
Right.
The Great Depression is going to happen
Right.
again
Right.
if we don't do this.
Right.
Okay. Now, do you feel that was a correct move? Were we staring at the abyss?
We never want our depository institutions to go under. We don't want banks to fail. The Fed's job is to keep banks from failing, and that's what they did.
Okay, because everybody complains about, especially Tea Partiers, okay, theoretical constitutional Tea Partiers, feel that we should have let those banks fail.
Well,
Like, what would have happened had we not done TARP? Just an idea, your best guess, if we had not done TARP. How many big banks would have actually failed pursuant to the rules that were there? They didn't have enough capital.
almost every major bank would have failed.
Every major bank,
Pursuant
to the rules that were
that
there.
exist. The capital
But they could have-
adequacy ratios were out of, no bank had regulatory capital sufficient enough to stay.
Under those regulations.
Under those regulations.
Now, would the Congress not have stepped in and told Treasury, let's lower the capital requirement so that, because the first few would have failed,
That could have been a solution.
there would have been runs.
And this is where politics came into play in a big way.
Okay, and they said that a better way to do it is, let's not let any of them fail because we don't want a run. Politics, the President of the United States, George Bush, and the Congress did not want a run. Everybody has seen bread lines.
Nobody
and it
wants a
scares.
run.
That's the abyss.
Right.
That's the abyss. Okay, so TARP appeared to work then if you say that the Fed's, one of their primary roles is to prevent runs on banks. We didn't have any runs. I mean,
That's right.
we had some idiots who were coming over, okay, who, remember? There's some friends of ours who consider themselves geniuses who went and got a bunch of cash out of the bank. And I remember going, dude, you are more likely to have your house burned down and lose that cash or get robbed coming out of the bank than you lose your $5,000 cash. So,
Remember, we had many money market funds in October, November of 2008 that were going to break the buck, which would have...
what do you mean break the
Break the
buck?
buck, what does it mean? Trade less than $1.
Okay.
Money market funds, which means...
They would be worth less than, and money market, everybody always thought that's just I have access to it, I get
Right.
5%.
But these-
At Fidelity, let's say, I put my extra cash in there and I get 5%. And you were saying that the actual trading of some of these public money funds were actually trading at less.
Correct.
People were saying, that's not even worth the $1 million that's there.
That's correct.
Okay. And that's a dislocation. There's something wrong when that happens.
Something very wrong.
We know that there's something wrong.
Part of the problem was these money market funds were actually also in mortgage derivative securities. So that's why they were breaking the buck. But
That's why they were
again-
paying 5%.
But again, if the average Joe's money market fund breaks the buck, that's a big problem and
Okay.
could cause another run.
Okay, so we were sitting there in October, November, and we have effectively saved all the big banks through TARP, saved them from the failing.
Band-Aids.
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 Right. And so we get past that, and then we're going through January through March. I think March 9th was the bottom of the stock market. That was the March 6th, March 9th. And so really what is going on from that time, from January through March, that people didn't understand that we had saved the system, I guess.
It was, quite honestly, I think that is a really psychological time, right? Everybody anticipated that we, or hoped that we had put this Band-Aid on and that January would turn and we'd have, we wouldn't continue to see asset prices fall. But that wasn't the case. Asset prices continued to fall.
Hey kids, how are
Hang
you?
on. Okay, we're just finishing a Fed rant here. Okay, so then what ended up happening, what's up, buddy? So, you don't want to get on camera, I promise you. NSA is watching this.
I had dinner with the NSA last night.
I believe it. It's the indelicate genius, by the way. Okay, so what I'm really just trying to get to is really to get us to QE2, okay, and QE3. And what really then is QE2?
QE2 is very unlike QE1.
Okay, QE1 was TARP, Band-Aids,
Right.
relieve capital strains
Right.
on assets that had dropped from all these banks
Right,
that
and-
would have made them fail.
Would have made them fail under current capital adequacy ratios.
Okay.
But QE2 is completely different. That's what's kind of funny. You name it something similar, but it's really it's a form of monetary policy that's never really been used before in the United States. It is something that Bernanke knows a whole lot about. And if he were not our Fed chief, we probably wouldn't be doing QE2. We may
Okay.
not be doing it because he understands that this credit deflation that occurred.
Okay,
is-
wait. What is credit deflation?
Well, it just means that the value of our credit has gone down, right? Prices keep falling, and the notes behind all of these.
When you say
assets-
credit, you mean the notes?
The notes.
Okay, so we're saying that these notes, these batches of things that sold for $100 million are now selling for $10 million.
Right, right.
Okay, so there's credit deflation. When you say credit deflation, I prefer saying promissory note value deflation.
Fine.
We
Fine,
just want to be
that's the same
clear.
thing.
Okay, so
Okay.
we've got all that going on, which means that, and we never know when these are ever going to be worth anything,
That's
ever
right,
again.
right.
We don't even know if the insurance policies sold on these things, they're against AIG. AIG is the one that sold them. Everybody sold
Well,
them.
that just got washed away.
Okay.
That got washed.
But some people did collect. We won't get into that.
That's
We won't
part
get-
of what happened in
Okay, so.
November of
okay.
2008.
Okay, so QE2, again, we are running up to, we've got promissory note deflation.
Right.
Value deflation.
Right.
And Bernanke understood this.
Bernanke understands this as being a very pernicious cycle.
And if we
Really-
don't do something about it, it's still going to drag the whole thing down. The abyss is farther away, but the abyss is still there.
That's right.
Okay.
And deflation, the prices of real assets and their continual decline is something that he recognized as what caused the Great Depression to occur. So he's doing everything he can keep
not-
that from happening.
Okay, so what exactly did he do?
Well, so what is QE2? QE2, prices. Our real asset prices have stopped falling. But what has to happen is the QE2 is more about the relative value of our currency anymore. Okay, it's not about asset prices as much as it is about how do we get inflation, how do we get growth to occur, and how do we satisfy those people who own our dollars. Okay, and so QE2 is it's more of it's not the salvation remedy that QE1 was, but it's as much a currency manipulation as anything else.
Okay, so what exactly is occurring in QE2? What are they doing? I thought they're doing 600 billion a month of something.
QE2 is taking even more of the depreciated assets off of the bank's balance sheets.
And putting them on whose
and putting
balance
them on
sheet?
the Treasury's, the Fed's balance sheet.
The Fed's balance
The
sheet.
Fed's
So the
balance
Fed
sheet.
buys these things from
Fed
these
buys
banks?
these things
How
from
many,
these
what do they
banks.
pay?
I don't know the
100
answer.
pennies on the dollar? What do you think?
30 to 60 cents on the dollar.
And what are they worth?
They'll be worth more than that.
But what are they worth now?
Nobody knows, that's why the Fed has to buy
Because there's
them.
not even a market to
There's
sell
not a
these
market
things,
to buy
and there's
them.
nobody buying.
No, and that's.
So right now, they're not worth
And it's.
the 30 to 60 that they're paying.
You know what, right now, that's exactly right, the Fed is supplying a price support,
Okay.
okay? The Fed is, and there's nothing.
They're the
wrong with
buyer
that.
of last resort.
They're the buyer of last resort.
And this is this a part of the Fed's purpose?
Yes,
Okay, because it's keeping, again, we have the same problem with the capital requirements of the banks are, again, we're butting up against these capital requirements to keep these banks from failing.
and so then we're printing more money and
600 billion a month or
we're
something.
printing a lot more money, and so,
So that money simply gets printed, and then the Fed gets this money? I mean, just mechanically, it goes through the Fed.
Yes.
And then the Fed, like, they cart it over to the Fed from the Treasury.
right,
Just follow me here.
Got it.
And then the Fed carts it over to Citibank, and they buy $100 million $100 billion worth of mortgages
right,
that are still sitting on Citibank's balance sheet.
Right.
And then those mortgages get away from Citibank. So
Right.
Citibank has now $100 billion of cash
assets.
assets
That are
that they
worth a
can
lot.
loan.
Right.
Well, they do
They're
have
not
some
depreciated.
leverage, and they do have some leverage.
Yes.
So they can loan out 200 billion, 300 billion, 400 billion, whatever it is. There's some leverage number.
Mm-hmm.
So it makes all the banks that they do this for healthier.
Absolutely.
What does it do to the Fed? The Fed now has all these mortgages.
Well.
Doesn't
you
do
know,
anything to the Fed.
Well.
All we did
the
was
Fed's-
pump this additional amount of money into the
balance sheet
system.
has never been as big as it is.
Okay.
It's never been this large.
Okay, I'm not going to ask you what that is because I don't understand what a balance sheet actually is, okay?
Fine.
But we do know this, that there's this huge sum of money that's being pumped out monthly into all the big banks to stimulate lending as well?
That is correct.
Okay.
So now
Because-
they are no longer constrained because they don't own 60 cents on the dollar assets. They own $1 on the dollar assets. So they're no longer constrained.
There's no
They're
constraint
not-
once it's a dollar.
The only
Okay,
constraint
okay.
is, who do I want to lend to now?
And that they still may not be loaning.
They're still not loaning.
Yeah, lending, sorry.
Lending.
Okay, so,
Actually, that's not true. They are lending.
okay, what is the net effect of 600 billion going out monthly? When does that have a real effect? It may have a real effect now.
It has a real effect now.
So the dollar is dropping because of this?
The dollar hasn't, the beautiful
Dollar
thing
really
about-
hasn't dropped,
The
has it?
beautiful thing about the dollar is it's a relative value and relative to other currencies. Had the European debt crisis not occurred, the
Then the
dollar
dollar
would
would
be
be dropping against at least the euro?
Right.
Okay, okay.
The dollar has dropped against the Asian currencies, but against its major trading partners, it hasn't.
Okay, which perturbs our lenders in Asia,
Well, yeah.
because the dollars that they hold are worth less.
They are worth less.
Okay, okay.
That's right.
So,
And
we're
we'll-
doing this thing because they think it's a good idea to do it, and that so far our economy has not been responding to anything.
That's
We've
not
had-
true. That's not true. We
Well-
have had nine consecutive months of private sector employment growth. We have had productivity rates that are good. We have seen earnings reports positive in all sectors. Our economy is doing quite well right now. The fact that
We always see this
unemployment's at 9.8%.
unemployment of this group, of this chunk
It
of the
always
majority of
happens.
Americans.
In every recovery, unemployment lags, and it lags. This is going to be a really slow slog out of this one because it was such a deep cut.
Okay,
But
okay.
the economy's doing quite well.
Okay. Now, the net effect of QE2, QE1, and the net effect of this may be over a long period of time to actually get us back to fuller employment, not full employment, but fuller than we are now, whatever, 9.8%. Get it down to 7% or 6, so whatever the number is going to actually be. We don't know what that new world order number is going to be. What is that going to do to the value? Let's just pick a specific item because we've talked about this in the past. What is that going to do to real estate property values in the United States? And I'm digressing here so that we can figure out strategies. In other words, we're seeing this thing happen, and let's say I have a $600,000 downtown Austin property. What is that going to do to the value of that property? If you know what I mean. Like you could say, it'll have a tendency to do this.
Yeah,
It'll have a
yeah.
tendency, we know at some point interest rates are going to rise. So when interest rates rise, values of property
Right.
rise less quickly
Right.
because the number of buyers is less.
Right.
It takes more income per month to qualify.
Yeah.
And incomes don't rise. So what is the kind of net effect?
I think real asset prices are going to have are not going to rise like we've seen them rise in the past. Okay, we're going to be a lot more careful about the asset real estate bubbles. Having said that, we've had bubbles before.
We will have bubbles
We'll
again.
always have bubbles. When just to mention when interest rates rise, it's important to remember there are two components to when interest rates rise or interest rates. Interest rates have a nominal and a real component. And so when inflation rises...
Wait. A nominal is the interest rate's 4%, but the real rate is...
What's really important to the Fed.
And it's what is the difference between a nominal and a real rate?
Well, the nominal interest rate is the real rate plus the rate of inflation.
Okay.
So you can have a
So the real
nominal-
rate's the amount on the promissory note.
That's right.
It says 5%. But if inflation is running at 2%, then the real rate is 7%. 5 plus 2.
No.
5 minus 2.
Correct.
5 minus 2. So
That's right, so the real rate's 3.
3. Okay.
All right.
Okay.
So right now, we have negative real rates.
Okay.
Negative
Because
real rates
in-
cause asset prices to fall.
Okay, which
That's
is
inflation.
the
It's
most
where we are.
it's the most dangerous thing that could possibly happen
It's where we
to
are.
anybody that owns anything.
That's correct.
Okay. So, what am I to do? I've been told over the years, pay down my mortgage, be a good boy. Okay? Pay down the mortgage, don't have debt. What is a person to do?
This is the best environment to go long a 30-year mortgage.
Okay.
Because-
So you're actually saying, and I don't give any advice, legal advice or financial advice to any of my listeners, but you're saying that the best investment at this point in time would be, if you had a paid off house, you're saying go get a 30-year home equity loan and take that cash and do what?
Oh.
And then we'll analyze this.
You are making some assumptions in your
Right.
assumption
That's how we
there,
come up
but,
with an
that's
example.
okay. I would be investing in equity securities and no debt. Bond holders are going to be made worse off.
When you
as a
say
result of
equity
QE.
securities, you're talking stocks?
Stocks.
Okay.
Stocks.
And what else?
All over the world.
And what else? Besides stocks?
Real assets, land.
Land.
Absolutely.
Around the world?
Commodities.
Not in the U.S.?
Real assets.
Not dollar-denominated
I have
assets?
no problem with dollar-denominated assets.
So really, then you're saying you could buy real estate
You
at this
should buy real
at this
estate.
moment?
Yes.
U.S. real estate?
Yes.
What about the depreciation that's going to occur because of the dollar drop that eventually
You know, if
happens?
you live and spend dollars, it doesn't have any impact on your real assets.
That's not what we talked about last night, because we were talking about the 94-cent loaf of bread that I buy at HEB that's been 94 cents for 4 years.
That's an inflation question,
Okay?
okay?
Well, what is going to happen to the value of the house that I go and buy for $500,000 with a 4% 30-year interest rate? What is going to happen to the value of that? Of that house.
If interest rates are rising and asset prices stop falling, because interest rates are rising because both the nominal and
Well, then we
the
know
real-
you're going to do well. If
Then you're
we
gonna
know
do
you're going to
fine.
do well,
That's
because
right.
if interest rates rise, then you're having it cheaper, you're paying it with cheaper dollars. Okay.
Not only that, but if the real rate's rising as well, the value of your property will rise.
Okay. So tell me this, QE2, is it a smart thing for the Fed to be doing?
Yes,
You agree with the QE2?
yes.
Okay. If they didn't do QE2, what would happen? Would we be back at the abyss?
No, but we'd be,
Just 10%, 11%, 12% unemployment.
Right.
15%
Right.
unemployment. Deflation.
right.
And deflation,
We're already in deflation.
I understand.
And so, without doing something to cause positive inflation, and that is without supplying the banks and through the banks, the rest of the economy through the bank multiplier, which is, I think, like an 8 times multiplier, so.
For the dollars, for the 600 billion that they're
That's
putting in,
exactly
that's an
right.
8 times.
That's a very traditional thing to do, is you supply the banks with money and the bank lends it 8 times over.
Okay.
Without that monetary inflation impact, we would be having a significant deflationary period of time.
Okay, so what else so the Fed is doing this independently?
No,
Because this is the Treasury doing it.
Yes.
The Treasury said to the Fed, we're going to do this. You're going to hand this, we're going to cart you all this money.
no, I think it was a
You're gonna-
policy that Bernanke came up with
Okay,
first.
okay.
Yeah, this is
But then they agreed with it. The Treasury
Sure.
agreed with it and
Sure.
really
facilitated it.
facilitated it. And so they talked to Obama, and Obama said yes, because he has to sign off on this.
You trust your
assuming.
experts, you gotta trust your
I'm
experts.
assuming that it went upstairs. This isn't some decision that just Bernanke decided to do it and he didn't care what Obama said?
Well, I'm not privy to that. They're supposed to be able to act independently, but the Treasury answers to the president.
Okay, so Geithner would have, or whoever, who's the new guy? Nobody even knows.
Goolsby.
Okay, Goolsby.
Nobody knows. I know.
No, that is true. Nobody knows. I was saying Geithner.
He's-
Okay.
he's
Okay, so we've got this supposedly independent institution that's doing the right thing, in your opinion, at this moment. When will they know to stop doing
That's
QE2?
the big question.
They don't know.
Nobody's smart enough.
And they will always, the pendulum generally always keeps going for a while. It just does, because everything lags. So they'll keep pumping, trying to bring down unemployment and trying to see positive growth in asset prices,
Correct.
meaning real estate prices, generally.
Correct.
Generally, okay. So that's what we're looking for. And what's going to happen is we won't see that until after they've already pumped too much money.
Well, that's the
That's
risk.
just an
That's the
idea.
risk.
That's what everybody is saying. That's what
That's
Tea
the
Partiers
risk.
are saying. Okay, so you're running that risk, and that risk leads to inflation of 7 or 8% possibly,
Right,
an interest rate rise of dramatic proportions.
Right, and nobody can imagine that right now.
Right, but when we're in it, if anybody remembers 1978 and 79, it was a scary time because you didn't know. You're like, wow, I can get a 13% CD. I mean, I remember the day you could get a 13% or 10%
I
CD.
remember it too.
And I was like, wow, I got to get some of those.
Right,
I need
right.
to borrow some money.
Right.
And at cheap rates, which I was able to get, and then
Right.
let's do that. Okay, so,
But remember now we're in a more global system, and the Chinese are going to support us pulling back and not allowing our currency to deflate as a result of hyperinflation.
so they will support us stopping QE2
Correct.
Right now, they understand the need for
They're
QE2?
completely fine with us doing it.
Okay.
We remember, we went over there before we did QE2 and had lots of meetings with
Okay,
them.
okay, so we told them, again,
There's a
theoretically,
cooperation between
between the lender and the borrower.
That's right.
Okay, the lender always
Right.
talks to the borrower.
That's right.
You loan your borrower $1,000,
Because-
you have the power. You loan your borrower $10 billion, the borrower has the power.
They could have gone out and sold all of our treasuries and bought Brazilian and
And they would have been done,
bonds.
and they would have been done on the
Would have been
value.
done. That's right.
Right, okay. So everything is kind of hunky-dory at the
It's
moment.
kind of hunky-dory.
Okay, do you have anything else you'd like to add? So it's sounding like all of the disinformation that we hear on everywhere. Joe Napolitano's show, he doesn't understand what the Fed does. All the Tea Partiers don't understand what the Fed
Well,
does.
I thought
Fox
one of
doesn't
the-
understand what the Fed does. Does CNBC understand what the Fed
Oh,
does?
but Sarah Palin understands what the Fed does.
We don't need to get into that. We know that Rick Perry understands what the Fed does, because he's fed up. Your future president.
Yeah, I'm happy to say that as a result of having gone to the National Association for Business Economists meeting recently, having been a member for 15 years and only once, this past month, attended a meeting, that economists that are actually studying this stuff and doing this stuff are so non-political, generally speaking. It's a group of people who have a very enlightened knowledge of monetary policy, fiscal policies, the impacts on economic growth, and quite honestly, don't really listen to these talking heads and their criticisms, because the disinformation, I got to be honest, I don't listen to it. I don't.
But I do. I rant so you don't have to.
Right.
And all that anybody is hearing about right now is that Ron Paul wants to dissolve the Fed.
Oh, that's ludicrous. What we should be looking at right now, as we're more financially integrated in the global economy, is a more globalized institution that can conduct monetary policy.
Okay, you're going to scare the crap out of people by saying that.
Well,
But that's the nature of the beast as we have it now?
I think so.
Because
but-
everything
but-
is global?
but not
Everything
that we-
big is global?
Not that we need a federal reserve,
Mhm.
right? We don't need the feds operating this global system, but we do need cooperation in part.
Aren't they cooperating now?
They are, but
But there's no formal system, like Goolsbee will call, he's talking to the central bankers in Ireland, or who is it that's failing right now that needed a bailout? Ireland, okay.
yeah.
So they're talking on the phone,
Oh, yeah,
but they don't have a red phone.
they may have a red phone.
But you know what I mean, it's like they're calling up going, all right, what's the problem? How much liquidity do you need? How much cash do you need? How many of your assets do you need us to take?
Right,
How many of the mortgage assets do you need to get off of your books? How much money do you need to hand to your banks
right.
so that they don't fail and
Right.
create the run that's going to become a global run?
It's-
Am I getting this right?
You are,
Okay.
it's just an incredibly fascinating financial kind of exercise that we have to do, in part because we have to make, and our models don't really capture the
What's going on.
financial integration that's occurring.
That is occurring. Okay, so we're behind the curve on modeling.
Correct.
We have plenty of modeling on, if we do this, the
Domestically.
unemployment rate's going to do
Right,
this.
right.
Yeah, right here, if we do
Domestically,
this.
right.
Okay.
So it's going to be a very interesting 25 years.
Okay, does the Fed need more oversight? Because apparently these big disclosures that just came out were shocking
The disclosures,
of what they had actually done in QE1, okay? Apparently nobody knew the size of the dollars
It's-
and that they gave them to Credit Suisse and UBS and these foreign
and
banks.
how much of that has been paid back.
Well, we know it's all been paid back. But,
So-
by the way, we've never really talked about all the guarantees that were signed, and nobody
Another rant.
ever talks about the guarantees. So the idea that GM might have paid back a big bunch of money, or AIG paid back money, or Citibank paid back money, we still, as a federal, our full faith and credit, has signed a bunch of guarantees on loans that are out there.
That's what the Fed's for.
Okay. All right, then I think we have a better handle at this moment, and we really appreciate your time, the delegate, because there's somebody else named Delegate, so we can only call you the Delegate. I see the indelicate is out there, and really appreciate your time here.
Pleasure.
This has been very, very informative to me, and hopefully we'll get some of the listeners in there, and maybe in a month or two, we'll try and do another one to see how QE2 is affecting things, see whether we get some inflation, see whether we get some interest rate rises, see whether we get some unemployment decreases or employment increases. And that's what we'll be looking for. That's what everybody should be looking for to see whether or not this works. And then don't listen to any of that advice about borrowing money against your house and buying, you know, a bunch of gold. So carrying less debt as a personal individual is obviously always a good thing, because you're always at risk of losing your job. So there's really simple ways to look at whether or not you should be just taking money out of credit lines and buying vacations, which we all know we shouldn't be doing. In any event, appreciate everybody, and we will be calling this one Fed number 1. Take care.